Hello everyone, and welcome back. In this video, we will explain three important things. First, what is a foreign currency account in the Maxis Web application? Second, how the system manages foreign currency transactions. And third, how to generate the correct statement of account report, whether the exchange rate is flat or fluctuating. So, what is a foreign currency account in Maxis? In the Maxis Web application, a foreign currency account is any account whose currency is different from the company's local currency defined in the system settings. For example, if the company's local currency is Jordanian dinar, then any account created in US dollars, euro, or British pounds is considered a foreign currency account. Let us take a practical example. Assume we have a travel agent called XYZ Travel. This agent's account currency is US dollars. Now, assume this agent has a group, and we want to send him an invoice. From the dashboard, go to Incoming module. Go to the group. Click on Invoice. Click Add New Invoice. Enter an amount, for example, 100 Jordanian dinars, which is the local currency. Click Save. When you try to post this transaction to the accounting module, the system will not accept it. Why? Because the transaction currency, Jordanian dinar, is different from the agent's account currency, which is US dollars. To fix this, simply go to the currency, change the currency to US dollars. Click Save, then click Post. Now the transaction will be posted successfully. Now, what if we want to extract statement of account report for this agent? There are two possible situations. First case, the exchange rate is flat. In this case, from the dashboard, go to Reports, then Accounting, then Statement of Account. In the filters, you can choose between Local Balance, Foreign Balance, and both of them to appear in the report. And in the Local Balance option, you can change between the local currency and foreign currency just in case the currency was flat. Second case, when the exchange rate is fluctuating. Let us take a demonstration example for a company called Maxis Travel. Assume we have three transactions on a certain group. First transaction is 100 US dollars at rate 0.708 equals 70.8 Jordanian dinars. Second transaction is 100 US dollars at rate 0.71 equals 71 Jordanian dinars. Third transaction is 100 US dollars at rate 0.72 equals 72 Jordanian dinars. So the total is 300 US dollars and 213.8 Jordanian dinars for local currency. In this case, if we want to generate a statement of account, we must choose the foreign balance option to see the correct report and correct totals. If we choose both, the system will show the US dollar amounts and their Jordanian dinar equivalent based on the historical exchange rate at the time of posting each transaction. Now let us understand how the system stores these numbers. Maxis stores each transaction with its original currency amount and its local currency equivalent based on the exchange rate on the posting date. For example, invoice number 133. The amount was 100 US dollars. At the time of posting, the exchange rate was 0.71, so the equivalent was 71 Jordanian dinars. If you select the local balance option and try to view the US dollar balance while exchange rates are fluctuating, the system will calculate based on the latest exchange rate stored in the system and will ignore the historical rate. That's why the amount will shift. For example, instead of 100 US dollars, it will show 100.283 US dollars. This creates a scattered and inaccurate report. So to summarize, if exchange rates are flat, you can use local balance. If exchange rates are fluctuating, always use foreign balance or both options to see accurate results. And this is how foreign currency accounts work in the Maxis web application, and how to generate correct statement of account reports in both flat and fluctuating exchange rate scenarios. Thank you for watching.